That is a look at the price of uranium, and you can see that it is very, very close to a 52-week low. Our next guest, however, is bullish on uranium based on a rise in demand for electricity around the world, especially electricity that does not contribute to greenhouse gas emissions. She's also bullish on gold. For details, joining us now is Bwana Chabra, Senior Market Strategist at Rosenberg Research. And as you can see, she's in our studio today. Thank you for coming in.
Thank you for having me, Paul. It's a pleasure to be here.
Okay, so we saw uranium prices. They have tracked down over the past 52 weeks from about $100 a pound generally to about $65 a pound now. So it's down about 35%. It's not an easy market to track. It's not as liquid as copper.
No.
There are fewer people, fewer experts who follow uranium. But you are constructive on the price of uranium. Go ahead.
Yes, so you said it rightly. It's a very thinly traded market, and there were other supply side challenges which have weighed heavy on prices. For example, as per Sprott, which tracks this physical uranium trust, they say that there has been selling of physical uranium towards the last quarter of the last year, which weighed heavy on prices, and it's a thinly traded market. But that's a supply side challenge. What we are looking at is supply-demand gap and the demand tailwinds that are on the horizon. So I'll take a minute to sort of dig deeper into the demand part before I come back to the supply part and supply-demand gap. So we definitely need more power. OPEC expects we need about 20 to 25% more power up to 2045. Of this, nuclear energy growth would be 70%. In our opinion, that's an underestimate. Why? Because that only includes nuclear power from sovereigns. Like China is putting up a lot of nuclear reactors. UK just joined the game. And then India is talking about it. US is also planning on bringing that on board. But there's a lot of private demand coming in. We had so many tech giants announce so many deals at the end of last year.
Yes.
That doesn't reflect in those numbers yet.
Right.
Plus, we had these small modular reactors which have become popular. So that have made the access to the technology so much more easier.
Who's using those small modular reactors? Are those power utilities around the world, or are those other users?
So they're very easy to put up. So you'll have a data center use this.
Right.
UK as a UK government is also thinking about putting up SMRs because they're so much easier to put together. So that's what we are talking about. They are going to democratize the technology, which was not the case earlier. And then we see a huge surge in power demand. I'm talking about tailwinds from not just AI, but we have electrification of cars, climate change is happening. We need more air conditioning, we need more heating. So we are talking a huge surge in power demand, and we want to get cleaner source of energy. Everybody is pivoting to nuclear energy, unlike what happened in wake of Fukushima disaster in 2011.
Do you have a forecast on the price of uranium over the next year or so?
So we're not really talking 1 year. We are talking multiple years.
Okay.
See, I'll come back to the supply-demand picture before I talk about the prices. The supply is very thin, like the whole spot market is very thinly traded. And then we have a very spotty market. We have few countries which supply it. So that's where the problem occurs. And then there are geopolitical headwinds. We had talks about the US taking off ban on Russian uranium exports. So those things are weighing heavy on prices. So it's difficult to say whether they'll resolve themselves in 6 months time horizon or 12-month time horizon. But when I'm talking 5 years, 10 years down the line, it should make up a part of your portfolio, because when it goes up, it'll go up in one direction, like we saw a couple of years back when Russia-Ukraine war broke out. So it'll need a catalyst. When would that catalyst come to picture? We don't know. But demand-supply gap is so huge right now.
Explain to our viewers what we're looking at here. Okay. This is the supply-demand gap. Explain the white field and the blue field.
Yes. So white field is available uranium right now, and the blue field is the gap that gets filled by recycled uranium or plutonium or thorium, which are not like very, very viable alternatives to uranium, but are used in nuclear reactors. So right now we have about 60% of that uranium being available. This would improve to 80%, but this will come down to 40%. So 60% of, let's say you need 100 tons of uranium, only 40 tons would be available. What do you do about the rest 60 tons? And that's the kind of scarcity we are talking 15, 20 years down the line. And that's why we are saying it's not a one-year call, it's a multi-year call, and we don't know when the catalyst would work out, but you should have it in your portfolio in small portions so that you reap that benefit whenever that happens.
And do you have a forecast on pricing?
Not really. Like I said, I'm not putting a number on that, but let's say we definitely see it scaling back to 100, which is like 35.
Right.
More, now it'll be more than 50% because we are talking 65 per pound price.
Right.
But I wouldn't be surprised if it goes beyond 120, 130. It's just that we are not putting a number because we are talking a multi-year forecast here.
Okay. So there are different ways that investors can gain exposure to uranium. The ones that come most to mind is Cameco, shares of Cameco,
Yes.
shares of Denison Mines or
Yes.
other uranium producers. There are also ETFs, I believe, that actually track the spot price of
Yes.
uranium. Talk to us about those and which do you favor at this point?
So we favor spot physical uranium trust right now. The reason being, like we were discussing the other time, miners have their own issues. They have their own cost pressures. They have their own operating leverage issues. Given spot prices are down right now, their earnings are seeing downgrades. Not a great time to be in miners in this particular case, but spot prices are at 52-week low, 35% drawdown from the peak.
Right.
Great time to enter right now. And whenever the recovery happens, it will happen here first before it happens in the miners. When we see recovery in prices, maybe a good time to start considering miners at that time as well.
Okay. Gold. You also follow the gold market very closely.
Yes.
Lots of interest in the gold market these days.
Yes.
We always watch it every day to see if it's breaking a new record high. It's very close to a record high. What do you see ahead for gold?
So we believe that the tailwinds for gold remain very strong. We have central banks buying golds. There's a lot of investing interest that has come back in over the last year. The headwinds from Fed cutting rates has also sort of gotten sidelined right now. So we see very positive momentum. And apart from that, there's a huge fiscal uncertainty, tariff uncertainty. So this is more like a fallback currency for a lot of central banks and a lot of investors right now. So we believe the tailwinds remaining intact till the time the whole macro and fiscal environment remains uncertain. And gold miners are definitely reaping benefit of that. So they become the second degree investment vehicle when the gold prices have run up and they haven't run up so much. So they automatically become the beneficiaries and offer a better risk reward profile at this point.
So it sounds like, if I ask you a similar question to ask you about uranium, it sounds like in the case of gold, you favor the gold mining stocks over direct exposure to the metal. Is that correct?
It would be more like balanced exposure to gold miners as well as the metal. The reason being, metal has a lot of strong tailwinds too. We don't see it falling sharply. For example, all-in sustaining cost for gold mining is around $1,500 per pound. And if the price was to fall down to $2,000 per pound, 15% of the supply for gold would be off market. Imagine the kind of floor it will provide to prices, and that's why we believe that gold miners are in a very beneficial position, and their earnings upgrade have already come in, but the prices haven't run so much. So there's an opportunity there, which doesn't exist for uranium miners yet, but we see it happening when the metal prices pick up. So metal in case of uranium right now, and gold miners plus gold in case of gold.
And last question, what do you look like? What do you look for? What do you look for in a gold mining stock?
Most importantly, how earnings are faring, because I understand there are a lot of challenges. You operate in different kind of political environment. There are cost challenges. There are accidents. So you want to look at companies which have strong discipline, but at the same time are seeing earnings upgrades and expanding margins because of the discipline. Now, when we did this analysis on the whole gold miners universe, we saw 85% of the companies match this requirement. So taking exposure to a bigger basket sort of mitigates company-specific risks and still lets you reap benefits of earning upgrades there.
Bhuwana, thanks a lot for this. Bhuwana Chabra is